We're going to be talking about the substance over form doctrine. Substance over form doctrine. The point is that the substance of a transaction, and not necessarily the form of it, will be the determining factor about the tax treatment and the tax consequences. So substance and not the form will determine the tax treatment. And when I give you some examples, it'll make that a little bit clearer. Now, we previously talked about sham transactions and sham events and sham entities. The substance over form is different because by definition with substance over form, there is some economic substance to this. So these are transactions that do have economic substance. So they're not shams, but there can be confusion. Now, to understand the doctrine and to understand some examples, the doctrine attributes the transaction, and I'm going to read this for you. The doctrine attributes the transaction to the taxpayer who receives the economic substance. The doctrine attributes the transaction to the taxpayer who receives the economic substance. Now, the taxpayer, you want to remember, is not just an individual. It could be an individual. It could be a regular corporation that we call a C corporation. It could be an S corporation. It could be a trust. It could be a partnership. It could be a limited partnership. Just about any kind. It could be a not-for-profit organization, for that matter. So when we talk about this doctrine and we say taxpayer, again, the doctrine attributes the transaction to the taxpayer who receives the economic substance. It could be any kind of taxpayer. Some examples of form over substance. I'm going to break them into two kinds of examples. And one's not any better or worse than the other. But some types of transactions have documentation behind them, and some do not have documentation. Now, that's good and bad. Obviously, if there's documentation, it's easier to come to a conclusion. But one example is this, where the documents describe, say, an independent contractor relationship between the two parties. But the people actually end up functioning as employer and employee. And it can't be both. So you're either an employee or you're an independent contractor. Now, if there happens to be documentation, that can be very helpful. Usually if somebody's an employee, there's an employment contract. If they're not an employee, there usually isn't a contract. An example of somebody who isn't an employee might be a person who is on the board of directors, but not an employee. Now, it's not unusual to find employees who are also on the board of directors. So they wear two different hats. So the board of director role would be a self-employed person, and an employed person would be an employee. The reason you get into this sometimes is that there's a big difference in the tax to a person who's an employee versus one who is an independent contractor. Generally speaking, there's not much difference in terms of the income tax treatment, but there can be a lot of difference in terms of the various payroll taxes they have to pay, things like Social Security and Medicare tax. So again, if it's a documented transaction, And you just have to make sure that the documents describe what they're doing and they're doing what the documents describe. There are also examples of payments that I can give you, say an owner. Let's say, like a lot of our clients are small closely held corporations. And the owners are frequently employed in the operations. So let's assume a check goes out to the person. And they're an employee, they're also an owner. Now, if there's no documentation, you get the question, they got this money. Is it a salary? Or is it a dividend? They're an owner, so they're getting dividends on their stock. Or is it a loan they're supposed to be paying back? Or is it a reimbursement of perhaps personal expenses that are being written off as a business expense? So it can be difficult sometimes, and you have to be careful, especially if you have owners, for example, of different, say, ages and different points in the life cycle. And let's say that one owner, maybe they own 25%, mid-30s, children, young children. The other partner is older, later in life, doesn't have children to support, doesn't have a college educations to pay for. Their needs for cash might be very different. Their needs for different types of benefits might be very different. But you have to look at, they're an owner, they're an employee. Is it salary? Is it a dividend? Is it a loan? What is it? So you need to be careful. And I think that's it.